Picture this. It's April 14th and you are scrambling through receipts, realizing you could have saved thousands in taxes if you would have just made a few moves back in December. Sounds familiar? Hi, I'm Aradhna Agarwal, and as a CPA, I see this scenario play out every single tax season. Today, we are diving deep into the critical difference between tax filing and tax planning, and why understanding this distinction could literally save you thousands of dollars. Let's start with the basics. Tax filing is reactive. It's looking in the rear view mirror at what already happened. You are reporting last year's income, deductions, and financial decisions to the IRS. Tax planning, on the other hand, is proactive. It's looking through the windshield at what's coming and making strategic decisions throughout the year to minimize your tax liability legally. Think of it this way. Tax filing is like taking your car to the mechanic after it breaks down. Tax planning is like regular maintenance to prevent the breakdown in the first place. The key insight: most people spend 40 hours a year on tax filing and 0 hours on tax planning. But here is what's crazy, that 1 hour you spend on tax planning can save you more money than those 40 hours of filing ever will. Tax filing is all about compliance. You are essentially telling the government story about your financial year using their forms, their deadlines, and their rules. What tax filing includes: gathering documents such as W-2s, 1099s, receipts, completing forms such as 1040, Schedule C, Schedule D, calculating what you owe or what you are getting back, meeting deadlines, April 15th, quarterly payments, and ensuring accuracy to avoid penalties. The filing mindset is, what do I need to report based on what already happened? But here is the problem with only focusing on filing. By the time you're filling out these forms, it's too late to change anything. Every number on the tax return represents a decision that was already made. As CPAs, we often say, you can't save money on last year's tax return. You can only report what happened. This is why so many people feel frustrated during tax season. They are playing a game where all the moves have already been made. Tax planning flips the script entirely. Instead of reacting to what happened, you are strategically deciding what will happen. You are taking control. Tax planning operates on 3 time frames. Annual planning, January through December. Income timing strategies, retirement contributions, business expense optimization, investment harvesting. Then comes multi-year planning, 2 to 5 years, Roth conversion strategies, business structure optimization, education funding strategies, estate planning integration, and then lifetime planning, decades, retirement distribution strategies, generational wealth transfer, legacy planning. The planning mindset is, what moves can I make now to minimize my lifetime tax burden? Here is a real example. Let's say you are expecting a bonus in December. With tax filing thinking, you just report it next April. With tax planning thinking, you might defer the bonus to January if you expect lower income next year. Maximize your 401k contribution to offset the income. Accelerate business expenses to the current year. The result: same income, but potentially thousands less in taxes. Let me share some powerful strategies I use with my clients. Number one, income management. Timing, bonuses, and consulting income. Managing capital gains and losses. Strategic growth conversions in low income years. Deduction optimization, bunching charitable contributions, timing business purchases, maximizing retirement contributions, business owner strategies, choosing the right business structure, equipment purchases and depreciation strategies, hiring family members strategically and legally, investment strategies, tax loss harvesting, asset location optimization, municipal bond considerations for high earners, estate and family planning, 529 plan contributions, gifting strategies, generation skipping techniques. Real client example, I had a business owner who was going to pay $54,000 more in taxes. Through strategic equipment purchase, retirement contributions, and income timing, we reduced their tax bill by $54,000. The planning conversation took 2 hours. That's a $27,000 per hour return on investment. Here is what most people miss. Tax planning and tax filing aren't separate activities. They are part of an integrated system. The most successful taxpayers follow this cycle. January through February, review last year's return to identify planning opportunities. March through November, implement strategies throughout the year. December, final planning moves and projections. January through April, file returns that reflect your strategic decisions. This creates a continuous improvement loop. Each year's filing informs the tax year's planning, which improves the following year's filings results. Without this integration, you're always playing catch-up game. With it, you're always playing offense, not defense. So here is my challenge to you. Stop thinking about taxes as something that happens to you once a year. Start thinking about taxes as something you actively manage year-round. Your next step, schedule a tax planning consultation as soon as possible. Review your current year's tax situation. Implement at least one strategy before year end. Remember, the best time to plant a tree was 20 years ago. The second best time is now. The same applies to tax planning. If you are ready to move from reactive tax filing to proactive tax planning, I would love to help. Click the link in the comments to schedule your strategic tax consultation, and let's make sure your next tax season is about celebrating savings, not scrambling for deductions. Thanks for watching, and don't forget to like and subscribe for tax tips that are practical, legal, and intentional.